Hey guys, this is Chris Mincola with the Mincola Group over at West USA Realty, and just wanted to give you your weekly market update. Um, Before I get started, I wanted to tell you some great news. One of the things that we were looking at for this week was the PCE, personal consumer expenditure. So I'm going to share my screen with you here so we can jump right into what we got from the Fed. Now, keep in mind, the Fed does not set interest rates, even if they say one thing or another, whether it's doom and gloom or whatever, even though what they're trying to do is demand destruction, which we talk a lot about. But the biggest thing to keep in mind is that the interest rates are driven by inflation. So if inflation is up, rates go up, inflation comes down, rates come down. So one of the indicators that we look at is this PCE, personal consumption expenditures. How much people are spending and paying for things. Prices are going down, supply chains are loosening up, according to the Fed. And real quick, I just want to kind of look at what Jerome Powell said here real quick. Let's watch this.
And our policy actions, which tighten financial conditions and are affecting economic activity, particularly in interest-sensitive sectors such as housing. So we can say that demand growth has slowed, and we expect that this growth will need to remain at a slower pace.
Oops, sorry about that. So we can see that demand has slowed, right? This is what they're trying to do: demand destruction. Sorry about that ad in there. Technology is great when it works, but this basically the point is that we see that we have this demand destruction, and he goes on to say that the numbers that we're seeing for these personal consumer expenditures, things like that, are starting to loosen up. So this is all great. Now we got a strong jobs report, which on its face sounds great, but when the Fed is looking at it, they're like, wait a minute, we're doing demand destruction, we're trying to tame inflation. And one of the things that could keep inflation rising is people getting jobs, people maybe getting pay raises and things like that. Because when we're trying to do demand destruction, this also does things like creates unemployment. Product development slows. Purchasing of new businesses will slow and things like that. $16 of every $17 in our economy is run by credit, right? So it's important to keep these things in mind when we're looking at this. So when we say payrolls and wages blow past expectations in this news article here, flying in the face of Fed rate hikes, which, by the way, he goes on to talk about the fact that they, are still going to be raising rates. Probably, we're going to be raising rates in December, raising rates again in January, maybe even into February. But instead of the 75 basis points, doing 50 basis points. And again, this doesn't directly affect mortgage rates as far as housing is concerned, but indirectly it does affect it. And basically, these Fed fund rate increases are to destroy inflation, destroy demand, destroy development. And that's why these, when we look at this on the face, we look at, oh, wait a minute, unemployment, the unemployment numbers are actually looking better than they thought. But let's face it, were these numbers really that high of expectation to begin with? And, what kind of jobs were they? Well, let's look at this. So non-farm payrolls, it said, increased 263,000 jobs. They were trying to get an estimated 200,000 jobs is what they were estimating. And yet unemployment's still low, but the unemployment rate is 3.7. It was 3.5 not that long ago. Average hourly earnings have gone up, which we told you would be happening going into the new year, which of course will help catch people up with the pay raises they received this year that weren't quite keeping up, but going into next year as inflation comes down, but pay goes up, we can start getting more affordability for things and housing. Okay. So let me click that off real quick. So we're not disturbed. Okay. So, average hourly earnings have gone up. Uh, so they're looking at this, and for the Fed and their thought process, again, behind the eight ball, all academics, never owned a business in themselves. But for demand destruction, it does make sense, even though they were late to the party on that. It does make sense that they're looking at this and saying, it's not quite what we wanted. But we have to also look at the fact that, about 50% of these jobs were, restaurant jobs, personal assistant jobs, things like that. Okay, about 50% of those. So, we also have 1.7 job openings for every eligible worker right now. So during the recession over the past 2 years, we've had the crazy run in stock market and crypto markets, and it's also caused a lot of people to retire early or earlier than they planned. Okay, one thing I've even heard people, and part of this kind of run into that. I had a client the other day who said, I have to retire by the end of this year because of the things going on with some of the energy sector, the Green New Deal, stuff like that. Or I lose $20,000, $30,000, $40,000, whatever the case may be. So these are things that also come into play. Now, sorry guys, I'm doing this from home today, so if you hear the dogs in the background, that's all that is. So we talked about the very exciting Jerome Powell here. Here's another great little article I wanted to show you. Investors bet on interest rate cuts in 2023 despite Fed signals. Now, why is this? Well, they're projecting that, investors predict Federal Reserve will cut rates when faced with slowing economic next year. Betting the U.S. Central Bank is far closer to ending its historic monetary tightening campaign than it's signaling. In other words, they're saying this, but we're really closer. Now, this would be in line with what I've been saying, and stolen from Barry Habib, a crystal ball award winner, 3-time crystal ball award winner. Nobody's won it twice. He's a 3-time winner. Okay. So usually, again, for what's likely, I'm not an economist. Barry Habib with MBS Highway, amazing stuff. Great information we like to bring in because he's usually right. And when we're talking about market updates, we got to bring him into the mix. And he's saying, first half of the year, we are going to be in that 5% category. Now, I got to tell you, I'm not a loan officer, but talking to and listening to loan officers with our clients, we're seeing a surge in applications, surge in phone calls, activity, open house traffic, all those sorts of things. Applications are going up. But why is that? Well, because we know back in July and August, when we hit that 5% mark, or right around that 5% mark, we saw a surge, a little tiny surge for about a month, July, August, with rates hitting that 5% mark, right? And that was because of how inflation ran year over year, and it came down, had a little bit of a drop. So we saw this kind of breaking point around 5%, 5.5% or so. And I got to tell you, with what, with just not buying down any rates, none of no fancy jujitsu with the rates, conventional, decent credit, not the best in the world. Conventional, from what I've been told, last couple of days was running, under 6, and for government loans around 5-ish. Again, these can fluctuate by the day, by the hour. So, it could change. It could have changed by the last time I spoke to somebody in the last day or two about, rates and stuff. But So what, and we're dealing with brokers, so they're going to get you better rates to begin with. So some of the information you see out there about, it was at over 7, now it's in the mid 6s to lower 6s. Some of that could be a little bit higher than what some of our preferred lenders in the wholesale lending market, as brokers shopping for the best wholesale deals, might get you. So just keep that in mind. But they're predicting by the first, but by around May, uh, we're going to probably see inflation and everything kind of peaking around that point. Now we know the money supply is going to be actually in low supply by March, believe it or not. We also are predicting through Barry Habib that we're probably going to be, in 5% interest rates, even for conventional, right around 5%, maybe even lower in the first half of next year, or by the first half of next year. And we're probably going to see, according to Barry, our inflation rate peak around January. Now, in January, there won't be a report for December because they're on break. So the Fed will come back and actually report in February what was going on in January/December. So let's kind of keep that all in mind. So, but this is great information. So, if we're wondering, well, where's it going to be by the end of the year, going into next year? Probably about 5.75% is what a lot of people are thinking. 5.75%. Again, just with decent credit, not buying down any points on a 30-year conventional. Okay, so home prices, are still up, which I'm going to get to, and we're seeing a little bit of surge. And all it would take is a little break in demand, since our supply is still low, which I'll get into too, to kind of bring some things back into balance market rather than a buyer's market, possibly going into eventually a seller's market if rates drop low enough. We'll see. No promises there. But it's what's likely to happen. All right. What's likely to happen versus, what is definitely going to happen. So we see again here, optimism grows as mortgage rates post biggest 3-week drop since 2008. They've been dropping over the last 3 weeks. So despite the silver lining, experts see dark clouds ahead. Now, one of the things that they'll say is, we're probably going to have some uncertain times. What we're saying is this, okay, just to kind of remember, a lot of this is clickbait. A lot of this is a lot of bad information that's out there. We always bring that up to you. So let's keep in mind that, the inflation drives the mortgage rate. So what we're going to see is we're going to see rates come down with inflation, with all this demand destruction the Fed is doing, and the money supply easing up a bit. We're also going to, see that, as the rates come down, demand will go up, and we're going to see, a lot of good things happening for people as far as affordability is concerned, because right now you can get a great deal and then you can do things like 2-1 buy downs or whatever. But even if you don't do that, by next year, you could refinance and get into a lower rate, but you got the great deal on the pricing this year. Okay. So it's important to know that we're going to see that trend down. And there's maybe, 2 steps forward, 1 step back, 2 step forward, 1 step back. In other words, but it's going to be trending in the direction of demand destruction, inflation down, rates down. Okay. So mortgage, mortgage max loan amounts are gone up. That was another thing that had come up this past week. So we see this was for Federal Housing Finance Agency announced on Tuesday that Fannie Mae and Freddie Mac will raise limit of baseline conforming loan, the highest loan amount for a 1-unit property to 726,200 in order to keep up with, the increase in prices. Increase of 79,000 from 2022. In pricier markets like San Francisco, goes on to say they hit over 1 million, and so on. So that's happened. Just to kind of keep you up to speed on that. Now, I want to jump into the Cromford Market Index. The Cromford Market Index lets us know if we're in a buyer's market or seller's market. If it's at 100 overall number, then we know we're in a balanced market. Okay. Below 90 is in a buyer's market, and above 110 is a seller's market. So we are right now on the index, we're at 88.4, that's below 90. So we are in a buyer's market in the greater Phoenix area. We also see that our demand index is at 71.4. Okay. So the overall index is, from being balanced, is down about 21.6, okay, points. On the demand, we're at 71.4. Okay. Demand is 71.4. So that's lower than 90. So that indicates a buyer's market. Okay. Low demand, that's lower than we're lower than 100. Okay. Would be complete balance. So that puts us at 28.6 lower than we would be for a balanced market on demand. And obviously that has to do with time of year, interest rate, all that. But supply is also staying at 80.8. Okay. So it's kind of keeping that even kill. Again, you're right. Again, just like last week, right around 19,000 units for sale on the MLS today. At 80. So we're on supply, we're at 80.8. We're in again, buyer's market. Okay. And the 80.8 would be, using a round number, 20 points or 19.2 points lower than it would be for a balanced market. Okay. So that's that. Now, if you look at the cities individually, we see that we've got increases on the Cromford Market Index. We've actually got increases happening. Let's see, for Fountain Hills, Cave Creek, Gilbert, and Surprise, they're actually increased. Okay. They actually increased. Overall, for, properties that we're kind of tracking here and what's going on for what's under contract, we're actually seeing things kind of level off on that index. They're not really, drop. Matter of fact, they just came up 1/10 of a point on the index overall. So listing success rate, let's take a look at that. Listing success rate is at 62% versus the long-term average is 67.5%. Okay. So nothing crazy off there, but a little bit lower than the regular average, again, with the higher rates than we're normally accustomed to. Now, historically, nothing nutty there either, but what we've been accustomed to for what for, it seems like forever, 8 years. And we've been hearing people talking about another crash. I mean, it seems like we've been hearing about that for 10 years, since right after the last one. So, this isn't going to, for those who want the doom and gloom and are good with the clickbait out there and buying into all that, we're going to see that a lot of those people are not happy. Okay. So some of the other things to kind of point out to you is contract ratio right now would equal 32.7% versus a long-term average of 70. Okay. 32.7 versus a long-term average of 70. Okay. And then we see single family home permits for brand new homes. All right. Permits of 11. Let's see, we got 1,149 in October. That's the lowest monthly total since 2015. Makes sense. We're in the holiday season. Demand is low. Rates are still high, even though builders right now, by the way, I keep pointing this out to you, they're doing a lot of incentives. They're reducing prices right now during the slow season. They are buying down your rate in some cases as low as 4.9%. I've seen pretty crazy stuff. They're offering, thousands, like $10,000 or more in incentives for closing costs and buy down rates and all that. So, guys, and a lot of these builders have spec homes, so you can move into them now or within a month or two or three, depending on your timing. But it's to get under contract at the end of the year. December is always the best month for getting under contract as far as getting the best deal. There may be a little less inventory, which is usual. If you look on a chart, it's always the same thing every year. Inventory drops. But if you have a buyer out there, sellers, if you have a buyer out there looking at your property, again, they are very, very, very serious buyers if they're out there looking. So let's keep that in mind. Now we see that so that's the lowest number of single family home permits since 2015. Again, builders learned from the last one, but this is also going to question, are we going to have the inventory? Are we going to have the inventory, guys, once we see the demand go back up? Are we going to have that inventory there? That's the question. So we're down 53% from October of 2021 on those permits for single family homes. Year to date, we've got 24,442 year to date. So that's lower than all years from 1996 to 2006. And then we have multifamily homes, which are going gangbusters right now. Year to date, 15,925 permits, up 30% year over year for multifamily homes. Okay. So people are investing in these multifamily homes, or companies are investing in these multifamily homes. And it's typically going to be for, rentals, right? You're going to have, a fourplex, sixplex, whatever. So we're seeing those kind of increases going on here in the Phoenix area as far as these permits are concerned. So, one of the things I would recommend that we let's take a quick look at this here too while we're at it. One of the things I wanted to show you was there's a lot, again, doom and gloom out there, right? And this is just some information from Redfin and what's going on with again, this is countrywide, but we have median sales price. Again, if we look at this, it's still up 4.9% across the country. Okay. That's great because typically, normally you're around 2 to 3% on that. We have, the seasonally home sold, seasonally adjusted, we're definitely down. But again, when your rates double from year over year, no surprise, or now we're close to double. Okay. If you're not buying down rates or doing a 2-1 buy down or anything. So I'm really not surprised about that. We're seeing, again, still seeing, the lowest, some of the lowest foreclosure numbers on record. Now, is there some instability? Are there a lot of layoffs, going on? Yeah. But again, you have to go based on context, right? So there's layoffs, but unemployment's still at 3.7%. We are already in a recession. Recession always equals lower interest rates. Okay. Bad economy equals. Yeah. Some people may be losing their jobs, but if you hire 2,000, got rid of 1,000, maybe you got to look at that in context of what is actually lost there. Also, we have to look at the fact that people have a lot more equity than they did back during the 2008 crash. And remember, that recession was caused by the crash in the housing market, okay? Due to poor lending practices, due to oversupply, which we do not have a problem with now. Okay. So new listings, seasonally adjusted, that's 511,000. We're down 24% in inventory. So that's keeping that, that's keeping it all in balance, right? With the low demand, because we don't have an over surplus like we did, back during the crash. We had like 3.8 million homes for sale. They overbuilt, and then they had poor lending practices to unload the homes. Yeah, these builders got, lenders to do these crazy loans to unload these homes, and then people couldn't afford them. Okay. Because of poor lending practices. We don't have that problem today. We don't have the over surplus. We don't have the poor lending practices. We don't have the foreclosure numbers. Okay. We just don't see any of that. Okay. So all homes for sale seasonally adjusted 1.55 million. Now, guys, you have about 1.7 million and new home formations. That means people get married, okay, or people get together, they get married, they form, the household. And so if you have 1.7, 1.5, does that add up to enough? No, that doesn't. Okay. And we're seeing that number is actually down by the month, but up overall. And we're still not keeping up with the demand. Because remember, builders, new homes are actually new inventory. Resale homes are really not new inventory, because pretty much, even if it's an investor, a lot of times they're buying another property after they flip that one. And if it's a regular homeowner, they're selling a property to buy another property, right? So it kind of balances out that way. So keep that in mind too. Monthly, okay, let's just, so even look here down at the bottom. Look at this. Average 30-year fixed, average 30-year fixed. So this is saying, 6.9. Now this was just in October, okay? So just in a matter of what, a few weeks, we've gone from 6.9 and now we're under 6. Again, depending on the day and all that. When I last I looked, if you're dealing with a broker, one of our preferred lenders anyway, shop the best rates for you, the best fees, all that, then you're going to be on a conventional 30-year under 6%, not buying down any rate, decent credit, not incredible credit. So look at that, just in a few weeks, that changed there. So it's just a lot to kind of put in perspective, guys, I think, to keep in mind. So right now, being in the Phoenix area, we are in a buyer's market. Okay. We're seeing the usual seasonal stuff and what we would expect if rates were pretty much almost double of what they were last year. And obviously prices have gone up overall. Now I'm going to be doing a separate video just to kind of get some other information in there about some of this stuff, kind of to get into some of the details. I don't want to make this video too long. I'm going to actually do one or two other videos to kind of get into what's going on with who actually was, buying these homes when our inventory had gone up a little bit, why the inventory went up a little bit. I'm going to talk a little bit about iBuyers in another video, but just keep in mind that those iBuyers right now, they're basically, when you're looking at an appraisal, they're pretty much going to be looked at as a foreclosure. So in other words, you really can't use them as a real gauge, because they way overpaid for pricing for the homes. And but look at the difference between last year and this year from this standpoint. Last year, you had to, if you wanted to get under contract, you might have to last year, you might had to have waived your inspect, which we would never recommend waiving an inspection. But so, a lot of times you'd hear, well, you got beat out because the other person wasn't going to do an inspection. So you had to maybe waive inspection contingency, waive appraisal contingency, waive loan contingency, give higher earnest money, faster closings. You got to move quicker, all this stuff, where now it's really kind of just it's kind of a more of a normal market, and if your home went up 500 to, from 400 to 500,000, and now it's 475 or 460, um you're still ahead, right? And I've done this in other videos, and I'll explain it in one of the next videos I'm going to make, on how the mainstream media, big names in the mainstream media, a lot of this stuff there, if you listen to them, you have lost literally hundreds of thousands of dollars by not buying a house sooner rather than later. So guys, all I can say is over time, real estate wins. Uh, you know, with some of the things that we've seen with this clickbait that's out there, and the doom and gloom and the crash artists to get clicks, it's just not correct information, guys. It's just really not correct information. Whether you're looking at national or local, it's not correct information. So guys, reach out to us anytime to get a home evaluation. Please, please, please share this video with your friends and family. Maybe, like this video, subscribe, and make sure you're following us on YouTube, Instagram, Facebook, and we will be sure to get a couple more videos out to you here in the next couple days. And if you guys have any questions, 480-788-8569, or you can check us out at MancolaHomes.com, MancolaGroup.com, or email me at home@MancolaGroup.com. See you guys next time. Thanks a lot.